There's no easy way to put this. My portfolio is down since inception, February 15th this year, $22,700. This month alone, we're actually down $25,000. And so we've gone from $118,000 down to $95. In this video, I'm going to talk about the top 10 biggest losers I have in my portfolio this month. And then I'm going to share what my plans are going forward. If I'm changing things, am I going to sell things? Am I going to buy more stuff? And then at the end of the video, I'm going to share a couple ETF options for people that might be interested in investing, but maybe don't like the volatility of individual stocks. Obviously, I'm not making any financial recommendations here, and I'm not a financial advisor, so make your own decisions. Here's the portfolio. We're talking about the top 10 worst performing stocks over the last month. We're looking at the last month here. Tesla. My position's down 31% over the last month. It's a 5% position in the portfolio. So we've lost $2,200 right there. And Tesla, it's sitting at right about $5,000. I am not doing anything different with Tesla. I am going to leave it, and I will keep buying shares as new money comes into the portfolio to get it up to that 7% size position. Gitlab, very important in the digital age, and more companies are moving to DevOps, which is the platform that they provide and the capabilities that they provide. And so I have no concerns that their market's going away. They do have competition with GitHub, but I think that market is big enough for both of them. Down 31% this month. It's currently a $6,200 position. Rocket Lab, another one, down 30% this month, $7,900. I've done a lot of videos on Rocket Lab. You can look back on the channel. There's nothing but good news coming from the execution of this company. They continue to have a perfect launch rate. They continue to see demand. They're expanding into new markets. I'm excited about the future of Rocket Lab, and my position on the stock has not changed. Mongo Database, $3,600 position. We are down 30% in Mongo Database over the last month. They had an earnings report, and they came in a little bit below kind of their guidance, came in below what analysts wanted it to, and people are freaking out about software valuations right now with increasing interest rates and just all things growth selling off totally. Mongo is in that situation. I'm keeping Mongo Database at a medium-sized position. It'll be about a 5% position and not considering selling at this time. Bill.com, they service, it's kind of like back-end financial operations type stuff. They do billing stuff, payments for small and medium-sized businesses, and a lot of freelancers and entrepreneurs get paid with Bill.com. $4,800 position, down 26% this month, and it will continue to be about a 6% position in the portfolio. No changes there. This is a tough time, again, for all these cloud companies, but small and medium-sized businesses are not going away. They're so early in that market, and most small and medium-sized businesses use really just archaic systems and a lot of manual entry systems for their back-end kind of bookkeeping and finance operations, so a lot of opportunity for Bill.com. Cloudflare, they're essentially just trying to make the internet more secure. $5,400 position. It's down 26% this month, and that's one of the larger size positions in the portfolio. It'll maintain around a 7% size in the portfolio. Four more. Snowflake, data is eating the world essentially, and Snowflake is a big part of that. And I just continue to see increasing demand, and the valuation, the multiple is only getting more interesting for me from here. $11,000 position is down 22%. It's already 11% of the portfolio, so it will not get added to for a while because I have it. Once it gets around 7%, it'll add if it goes under 7%. But until then, it's not going to actually add to Snowflake. There's a lot of other companies that I am building up. Datadog, $7,500, down 21%, so not quite as bad. Again, we'll maintain about a 7% position, which is, it's almost 8% right now. CrowdStrike, again, cloud security, endpoint security, $7,800 position, down 20% this month, and it will maintain around 7%. The Trade Desk, they do programmatic advertising. So they allow people to essentially buy advertising across a lot of different platforms, connected TV, the internet, all different places. $5,700. It will maintain around a 5% position. And then Shopify, Mercado Libre, e-commerce. Obviously, Mercado Libre focuses a lot on Latin America. Shopify is kind of trying to save people from Amazon essentially in some ways, because Amazon hurts a lot of sellers in some ways. So $3,800 position. These, I look at them both, they're each 5%. I look at them kind of as one. 10% dedicated to e-commerce is kind of how I'll keep the portfolio. Here's why I'm not selling these positions. You didn't hear me say I'm going to sell any of those positions. A, I like them before. If the stock gets cheaper and the business continues to perform, I should actually want to buy it more, not sell it. Now, if the business fails or things start to deteriorate, then I wouldn't want to own it anymore. But that's not the case in my opinion. And here's just an indication. These are just estimates, right? But the expected forward revenue growth rate of these companies: 75% for Bill.com, 73% for Snowflake, 55% for Tesla, 54% for Datadog, 51% for CrowdStrike, Mercado Libre 49, Cloudflare 45, Airbnb 41, MongoDB 37, The Trade Desk 33. So look, these companies are all growing in double digits. In fact, the 3 slowest growing companies that I have are Taiwan Semi, which I added this week. I did a video on it, so check that out in the feed. It's just a super strong company and super undervalued, a nice dividend payer too, and a secure dividend. Meta, which is, in my opinion, is very undervalued, but that's a long-term play for AR, VR, Oculus. Again, that's not necessarily a growth stock for me, but I think they will grow over time, but it's more of just a crazy value play. And then Advanced Auto is a slow grower, but they are buying back shares. Again, this is another one, pays a dividend. I think in a recession or not, people are going to need to spend money on their vehicles. And Advanced is, I just think the business is undervalued and happy to own a couple dividend payers. Clearly not going all dividend, right? I have a ton of just growth stocks. And then you got Rocket Lab and Gitlab, which they don't have the forward revenue projections, but Rocket Lab grew at 130% year over year, and Gitlab grew at 70%. So all of these are strong growth companies. They're going to be volatile. If you don't like this volatility, my family members, I tell them to buy SCHD, the Schwab Dividend Growth ETF, and then if they want some growth but don't want to manage individual stocks, Vanguard Growth ETF, right? Do your own research on these. Morningstar has some good research. You can look at all the companies in them, but SCHD pays a 3.5% yield, VUG pays 0.7%, and then SCHD dividend is growing. Over the 5 years, it's compounded at 12%, whereas VUG has actually dropped a little bit. And then here's just the performance, right? 10-year performance, SCHD 141%, VUG 200%. And if we look year to date, SCHD is going to be a lot less volatile. 14% versus 33% loss for VUG. So 14% loss for SCHD, 33% loss for VUG. Am I crazy for owning this portfolio? Should I be selling everything? What are you doing with your portfolio? Let me know. Have a great day.